Both sides of the Fed's dual mandate are flashing. So what does that mean for interest rates? As traders brace for what could be the first Fed rate cuts in 9 months, a growing chorus of analysts are sounding the alarm. This might be a mistake. Inflation is climbing and Fed Chair Powell has warned that there's now a greater risk the job market could falter. So who will win, the doves or the data? James Smith is developed markets economist at ING. So James, the Fed's preferred inflation measure proved stubbornly high in July. What's keeping prices elevated?
Well, interestingly, it's services right now. Goods price inflation was actually more benign than many people expected in the most recent month, whether you look at CPI or whether you look at the PCE numbers as well. Now, the question is, what's going on with that tariff impact? Does it suggest that consumers aren't going to pay for the tariffs? Are corporates absorbing the cost? It's possible, or are we just seeing a longer lag time? Could we see those inflation figures push even higher as we head into the autumn? Maybe the stockpiling that went on earlier this year is giving companies a little bit more time. It's still a bit of an uncertainty.
More uncertainty as well in the labour market. US initial jobless and continuing claims edged down last week. So how soft is the labour market and should the Fed be worried?
Well, we know the big downward revisions we saw for May and June put net job creation pretty much at zero. And you don't tend to see that outside of recessions in the US economy. The question is, do we see that repeated next week? Sort of hard to tell. The numbers have been very volatile. I think what is interesting is that the Fed is putting a little bit less weight on payrolls right now. It is more focused on the unemployment rate, which has been more stable. I think the argument is that the immigration policies, the reduction in labour supply that's potentially having maybe means that you've got this interesting situation where, yes, hiring demand is coming down, but there are fewer workers available as well. And that's maybe contributing to the lower payroll figures.
Meanwhile, the US economy expanded in the second quarter at a slightly faster pace than initially estimated. How do you think this is playing into the Fed's thinking?
Well, the GDP numbers have obviously been very volatile everywhere through the first half of the year. That front loading, of course, in the US saw a big surge in imports in Q1, and that's obviously unwound in the second quarter. I think we are looking at slower growth numbers into the second half of the year, but I think at the moment the Fed is more focused on those job numbers, but also inflation as well.
Well, markets and policymakers are calling for a reduction in September. Is this certain at this point, or could this be a mistake?
Well, it's basically fully priced by financial markets. And I think, Jerome Powell, by kind of opening the door to a rate cut, saying that the Fed might be inclined to ease policy, it sets quite a high bar, I think, for them not to cut rates in September. I think the more interesting question is how quickly do cuts come through thereafter. Clearly, the next couple of data points over the next few weeks will help determine that. But, look at the jobs numbers. They are very weak. And our feeling is that the Fed will have to cut rates fairly swiftly through the autumn. We think there's going to be 3 more rate cuts this year.
Another hurdle for the Fed is political pressure. Are markets being complacent over President Trump's escalating attacks on the central bank's independence?
Well, I think it's interesting. We've not seen a gigantic reaction to the news surrounding Lisa Cook being fired and sort of subsequent legal challenges. I think it's quite a nuanced story. There is that legal challenge to kind of figure out, and then there's lots of other sort of moving parts as well. If you think about the Fed governors, lots of people are sort of thinking that Bowman and Christopher Waller, both Trump appointees, both more inclined to cut rates, will be inclined more to side with the White House, but that may not be true. So there's a lot of question marks here. We are seeing steeper curves, which makes sense because, more dovish Fed means lower rates today, but potentially higher inflation in the future, which is bad news for bonds. That feels like the correct reaction, but feels like this story is only really just getting started.
That was James Smith from ING. Don't forget, you can watch more videos on Reuters.com.